If you own a home and you're even thinking about selling it, there is one government rule you need to understand before you make a single move. It's called the 5-year rule. And no, it is not actually brand new. But for homeowners in 2026, it just got a whole lot worse. Not because the IRS changed the basic test, not because Congress passed some dramatic new headline law about primary residences, but because the housing market changed, home values changed, life situations changed, and the tax break that used to protect most homeowners has not kept up nearly the way people think it has. For years, millions of Americans were told some version of the same advice. If you sell your main home, you may be able to exclude a big chunk of your profit from taxes. And that is still true. The IRS says you may be able to exclude up to $250,000 of gain if you are single, or up to $500,000 if you file a joint return with your spouse. That sounds generous. It sounds protective. It sounds like the kind of rule that keeps ordinary homeowners safe. But here's where the story changes. That exclusion amount has become more fragile than most people realize. According to the Congressional Research Service, the exclusion caps were not indexed for inflation or housing price changes, and as housing prices rose, a larger share of homeowners became exposed to taxable gains. In plain English, the tax shield stayed still while home prices kept moving. So the same rule that once covered the vast majority of sellers is now much easier to break through, especially in higher cost markets or for people who bought long ago and built up significant appreciation. That is why this 5-year rule matters so much. Because the government is not just asking, did you sell your house? It is asking, did you own it long enough, live in it long enough, use it the right way, avoid certain other sales recently, and stay inside the gain limits? And if the answer to any part of that is wrong, the tax bill can change fast. So let's break this down the right way. The basic version of the rule is simple. During the 5-year period ending on the date of sale, you generally must have owned the home for at least 2 years and used it as your main home for at least 2 years. Those 2 years do not have to be continuous, and for married couples filing jointly, only one spouse must meet the ownership test, but both spouses generally must meet the use test to qualify for the full $500,000 exclusion. That sounds manageable, and for a lot of people it is. But now let's talk about why this got worse. The first reason is simple. Home appreciation has outrun the rule. The Congressional Research Service notes that if the $250,000 and $500,000 exclusion amounts had been adjusted to reflect changes in housing prices since the late 1990s, they would be far higher today. CRS says that by 2025, using average housing price changes, those thresholds would be about $720,000 for single filers and $1.44 million for married couples. Even using broader inflation measures, the adjusted numbers would still be meaningfully higher than today's fixed limits. That means homeowners are dealing with a tax break that looks large on paper, but is much smaller in real-world housing terms than it used to be. And that is before we even get to the traps. Because the biggest mistake homeowners make is assuming this is a sell your home tax-free rule. It isn't. It is a conditional exclusion rule. And conditions are where the trouble starts. Let's say you bought a home years ago, moved out, rented it for a while, then moved back in, and now you want to sell. Many people think, well, it was my home, so I should be fine. Maybe, but not automatically. The IRS says gain may not be fully excludable if part of it is allocable to periods of non-qualified use after 2008. In general, non-qualified use means periods when neither you nor your spouse used the property as a main home, with certain exceptions. So now you are not just dealing with a simple 2 out of 5 test. You may also be dealing with allocation rules that reduce the amount you can exclude. And this is exactly why the rule feels worse today than it did in old kitchen table tax conversations. Back then, the advice was casual. Live there for 2 years, sell it, and keep the profit. Today, the real question is much more technical. Was it your principal residence? For how long? During which parts of the 5-year window? After which move-out date? With what kind of rental or business use? And how much depreciation did you claim if you rented any portion of it? That is a completely different conversation. Here's another way this got worse. More homeowners now have multiple property lives. People downsized, people inherited homes, people started splitting time between states, people kept the old house and bought a new one. People moved for caregiving, work, health, or family reasons. And the IRS is clear. If you have more than one home, you can exclude gain only on the sale of your main home, not your beach house, not your rental, not the place you visit 3 months a year and emotionally think of as home. The home that matters is ordinarily the one you live in most of the time. And there is a second trap many people never see coming, the once every 2 years rule. Even if you meet the ownership and use tests, you are generally not eligible for the exclusion if you excluded gain from the sale of another home during the 2-year period before this sale. So if someone sold one main home, claimed the exclusion, moved again quickly, and assumed they could do it a second time, the IRS may say no. Now let's talk about the emotional trap. People confuse profit with taxable gain. Those are not always the same thing. Your gain depends on your basis, which is generally what you paid for the home, plus certain costs and improvements minus certain adjustments. The IRS specifically tells homeowners to keep records that help establish basis and selling adjustments. Why? Because once prices rise enough to push you near or above the exclusion cap, documentation starts mattering. A new roof, an addition, major improvements, closing costs, and other adjustments can change the gain calculation. And the CRS report points out something important here. As more homeowners become exposed to the cap, more of them are forced into record keeping and tax complexity that the original exclusion was supposed to reduce. That means the pain is not just, you may owe tax. The pain is also paperwork. It is calculation. It is tracking improvements from years ago. It is trying to reconstruct basis after decades in a property. It is realizing too late that your records are incomplete. That is one of the hidden ways this rule got worse. Not just more exposure, but more compliance pressure. Now, there are exceptions, and these matter. If you are physically or mentally unable to care for yourself, the IRS provides a special rule. If you use the residence as your main home for at least 12 months in the 5 years before sale, time spent living in a licensed care facility can count toward the 2-year residence requirement. That is a huge detail for seniors and families dealing with assisted living or nursing home transitions. A lot of people assume moving into care automatically destroys the exclusion. That is not necessarily true. There is also relief for certain people on qualified official extended duty in the military, foreign service, or intelligence community. The IRS says eligible taxpayers may elect to suspend the 5-year test period for up to 10 years in some cases. So if government service pulled you away from the home, the clock may not work the same way it works for everyone else. And then there is the partial exclusion issue, which a lot of homeowners overlook until it is too late. You do not always have to meet the full 2-year requirement to get some exclusion. The IRS recognizes partial exclusions in certain situations, including some sales related to work, health, or unforeseen circumstances. That means the rule is not always all or nothing. But here's the catch. Partial relief is not the same as automatic relief. You still have to qualify under the specific IRS rules. Now let's talk about what really makes this dangerous in 2026. Homeowners are making modern housing decisions with outdated mental models. They think the rule is simpler than it is. They think the cap is larger than it feels. They think temporary rental use does not matter. They think moving out for just a couple years cannot hurt them. They think if they are married, the full $500,000 is automatic. They think selling at a loss creates a deductible loss. It does not. The IRS says a loss on the sale of your main home is generally not deductible. And there is one more piece that homeowners ignore because it sounds administrative, not financial. Reporting. If you receive Form 1099-S, you generally must report the sale, even if you think the gain is excludable. And if you cannot exclude all of the gain, or you choose not to exclude it, the IRS says you may need to use Form 8949 and Schedule D. In other words, this is not always a situation where the sale quietly disappears from your return. Now, let me show you the real strategic lesson. The 5-year rule is not just a tax rule, it is a timing rule. That means it changes what date matters. Not the date you move emotionally, not the date you decide to sell, not the date you list. The date that matters is the sale date measured against the prior 5-year window. That is why a homeowner can be 1 month early, 1 month late, or one move out too far removed and suddenly lose part of the benefit they were counting on. This is why timing a sale after a move to assisted living, after a rental conversion, after a second home purchase, or after a job relocation can be far more expensive than people expect. So what should homeowners do right now? First, stop calling this a tax-free home sale rule. Call it what it really is, a qualified exclusion with timing, use, gain, and reporting conditions. Second, figure out whether the property is clearly your main home under IRS standards. Third, map your last 5 years on paper. Actually write down where you lived, when you moved out, whether you rented the home, whether you used part of it for business, and whether either spouse fails the use test. Fourth, reconstruct your basis as carefully as possible, including major improvements and other adjustments. Fifth, if you sold another main home recently and used the exclusion, check the 2-year look back before assuming you can do it again. And sixth, if you are in a special category, care facility move, disability, military duty, unforeseen move, partial exclusion situation, do not guess. Those exceptions are where small misunderstandings create big tax differences. Here's the bottom line. The government's 5-year rule did not suddenly become cruel overnight. What happened is something more subtle. Housing prices rose, life got more complicated. More people turn homes into rentals, move in with family, split time between residences, or hold properties longer and gain more appreciation. Meanwhile, the exclusion cap stayed fixed, and the tax code kept all its conditions. That is why the rule got worse for homeowners. Not because it is new, because it is old in a world that changed. And if you remember only one thing from this video, remember this. The danger is not just selling your home. The danger is selling it with the wrong assumptions. Because in 2026, the homeowner who loses money is usually not the one who never heard of the 5-year rule. It is the one who heard of it once, years ago, in a simplified form, and never realized how much more complicated and how much more expensive it had become. So before you sell, before you convert the house to a rental, before you move out for just a while, before you promise yourself the first $250,000 or $500,000 is automatically safe, stop and run the timeline. Because the 5-year rule is no longer just a box to check. For many homeowners now, it is the difference between walking away with your gain protected or handing part of it back to the government.